Well, g'day there, traders and friends, market participants, and enthusiasts right around the world. You are here with James on behalf of Pivot Point Trading as I bring you this weekend market update. It has been a relatively interesting week, given, of course, a little bit of selling pressure which we saw begin to flow into the markets. On the weekly chart, we were down just over 315 points on the Dow Jones Industrial Average. What makes this even more interesting is the simple fact that it's showing up at this very important and significant resistance area, just shy of 21,130, give or take. In fact, since we established this upper wick 4 weeks ago or 3 weeks ago, we have had 2 consecutive weeks of spinning tops. And really the week just past was the first time where we saw any real material type of pullback. And what I mean by material pullback is that on Tuesday, it was the first time that we closed down over 1% and I believe over 110 trading sessions. On top of that, it has been the most bearish week in, I believe, the past 6 months worth of trading. Now, although it isn't all that bearish, I mean, we've only pulled back from 21,120 down to about 2,600. What is most peculiar at this particular point in time across the board for the US equity markets is the simple fact that we have this 2-day candlestick pattern in alignment, or very much so in agreement with a very important type of gap. Now, this is what we call a tweezer top. This is the Dow Jones Industrial Average on the daily time frame. If I change to the S&P 500, you can see that very similar 2-day reversal pattern which set up during the first 2 trading sessions in March 2017. If I change to the NASDAQ again, very similar, however, a little slight change in difference. It is what we call a one black crow, but again, it fits the profile and the story and the narrative of what we call a tweezer top. Now, what makes this interesting is that during this time and during this 2-day potential reversal candlestick pattern, we were floating the idea, at least, that is this, or at least asking the question, is this some form of a continuation gap, which really suggests that potentially we were roughly halfway through the bullish move, which we've advanced off from since early November 2016, or is this some form of an exhaustion gap? Now, fast forward over the past 3 weeks, you can see for yourself, this is still the Dow Jones Industrial Average on the daily time frame. You can see that we pulled down, or we pulled back, we filled the gap, we tried to bounce, and the week just passed, you can see what happened. The bottom, so to speak, on the micro level has more or less fallen out of the market. On Tuesday, you saw, again, that 1% or at least over 1% sell-off. Wednesday and Thursday, we tried to stabilize, and then again on Friday, we saw a little bit of the continuation in selling pressure, down 60 points. On the S&P 500, a very similar type of scenario taking place. Tuesday was where the damage was done, so to speak, but again, we sort of stagnated Wednesday through Friday, which is what I was suggesting was going to happen in the most recent market update. Again, on the NASDAQ, you can see this long day engulfing Marubozu candlestick. However, you can see the consecutive 3-day candlestick since Wednesday through Friday. It really suggests that we are getting a temporary bounce to the upside. It does really resemble that of a bear flag, and I'd be really curious to see what happens if we can push below this little support level, which is taking place around 5,780. Now, if I change back to the S&P 500, I want you to pay very close attention to this current sort of price reading that we're printing at as at the close on Friday. The reason for that is because if we go all the way back to 1994, towards the end of 1994, if not the beginning of 1995, which is really the parabolic rise which led us to the top of the 2000 bubble, the NASDAQ.com bubble, you can see that we have this trend line. Now, what I'll do, I'll change from the bar chart to the closing chart just so you can see this line very clearly. And again, I want you to pay attention to this trend line. This trend line, again, it is relatively relaxed, but what is most important at this particular date is the extension of this trend line. What happened was, since the unraveling and the deleveraging of that bubble, which took us through to the end of 2002 to the beginning of 2003, where we established once again the bull market right through until the top in 2007, if we take, and if you pay attention to these 2 red lines, which are sort of extensions, we call them extensions in the world of technical analysis, just pay attention to these trend lines. You can see that if I go back to the current juncture, these are the extensions of those 2 trend lines. So if we look at the S&P 500 right now and we say that, look, we've got this tweezer top, we have potentially an exhaustion gap, which again has filled, and we're seeing the continuation below it. It looks as though we have a short-term double top. We're resting right on what was once resistance as new support. So again, we're assuming this is going to hold as new support. Now pay very close attention to what it is I have to say. Here we are, essentially a lot of people are addressing and looking at this market and saying to themselves, look, we're at the neckline of potentially a double top, which is technically true, okay? It is true. However, given the context of this extension, and if I start showing you the short-term oscillating types of readings which we're seeing, especially the RSI, we are very much so short-term oversold. coupled with the simple fact that we are very close to resting on that 50 advancing exponential moving average. This is really what I'm sort of taking away in many cases from the current technical snapshot. A lot of people are short-term bearish on this market, and justifiably so. I understand why that is. However, having said that, the trend on both, I guess, the intermediate and the macro picture is still up. Maybe not so much the micro level, because again, we have seen a little bit of weakness flow into the market. However, we are again pronounced and sitting on that 50, along with those extensions which should act as new support. Because of that, I am hesitant personally to short this market. And it's simply something that I am not doing, and something that I have addressed, of course, in the pro analysis recording, which is just posted up online on the website. What you should be thinking about and paying attention to is the simple fact that we are most likely going to rally. And again, that may come as a little bit of a surprise, because if people pay attention to the oscillators, they are still bearishly aligned, and it does suggest that we are going to see some continued weakness. The reason why I say that I am expecting a bounce, even though technically we are closing on the neckline, if not we've posted below it, is this simple fact right here. And again, when we start looking at divergences, and again, just classical chart structure in terms of chart patterns, generally what happens is when we get and form these divergences which are taking place, say for instance, on the daily timeframes, or at least these macro sell signals, we generally bounce back up, and you want to pay attention to this pivot point right here. And this is something that I've alluded to very early on in the week. Oftentimes what we'll do is we'll get the rally back up. We may even overshoot it, which will confirm divergence. And then what appears to be the neckline, or the very important pivot point at this particular juncture, will often signify what is to be the retracement, or at least the confirmation of the intermediate trend, which is going to usher in more so of a material pullback. Now, although it has been a relatively bearish week, again, we've been expecting this based on this ADX indicator, which is, if I can bring up the right template for you, just here. If you go back to very early on in March, I would have updated or at least posted a video on the YouTube channel suggesting that you should pay attention to the ADX when this definitively turns down, because when it turns down, mixed with this chart pattern and again this candlestick pattern and the gap pattern, it does suggest that the market itself is going to digest a lot of these gains. That is exactly what has happened since the month of March, the beginning of March. Here we are at transitioning into the final week's worth of trading. We are down 19 points on the S&P 500. We are down 215 points on the Dow Jones Industrial Average, and the Nasdaq, it is posting positive just by 3 points. But this ADX signal is telling, because you can see once it turns down, it means we're moving into the reset zone. The ADX hasn't aligned, and it hasn't adjusted all the way back down to 20. So we have a little bit longer to go. However, the CCI, the Commodity Channel Index, which should be posting above 100 during a bullish trend, has definitively closed back below that positive 100 reading. So again, we're in the sort of, in the transitional phase, so to speak, in the technical world, as we start addressing and analyzing and forecasting financial markets, that look, you have to be open to, I guess, the degree of gray area in this market at this particular point. A lot of people want to look at this market again in black and white. It's simply not the case at this particular point. You have to keep the door open to potentially the rally which may overcome resistance and continue. If you see that, you want to see the markets in agreement across the board with the S&P and the Nasdaq as well. Of course, aligned with the industrial average, but there is a very significant chance that on this bounce, which I assume we're going to get, it may not happen from exactly this location. We might sell off a little bit further, but on the inevitable bounce, and listen to me very, very closely right now, on that bounce, what you want to be paying attention to is what happens at roughly 21,000, what happens even a little bit higher at 21,000, say for instance, 21,150, give or take, back to these recent historical highs, these swing point highs at the beginning of March. Because if we fail, and if we turn down at this particular point, all right, that is very much so the most bearish recording, or at least the most bearish signal that we can possibly get, mixed with a few of these other indicators I've already addressed across the board in this most recent market update. If you pay attention to these higher highs, which we've put in context to the stagnation during December and January, during the sideways market move, you can see that we are forming divergences on the daily chart. If I go out to the weekly chart, pay attention to this signal also. Look at this signal. We're starting to get the sell signals on the Dow, the sell signals on the RSI, sorry, not on the Dow, on the stochastics on the RSI, and also on the MACD as well. So these are major warning signals that are across the board. If you pay attention to it as well on the S&P 500, pay attention to what happens in the past when we get these sell signals on the weekly chart. Bad things happen in the market, aligned with, of course, a lot of bearish indications in terms of candlesticks, which have been setting up over the past 4 weeks. I mean, we've got a shooting star candlestick right here, We have a little gravestone, or not so much a gravestone, but a dragonfly doji here. This was 3 weeks ago now. We have a spinning top 2 weeks ago, and the week just passed, we've got the engulfing candlestick pattern on the S&P 500. If you pay attention to the NASDAQ, of course, again, if I bring up the same oscillating indicators, you can see the MACD about to cross. The RSI is adjusting from overboard, and the stochastics, you can see for yourself, it is only just starting to turn down. So, I mean, this might be the beginning of a bigger move. Time will tell. But as I have addressed the Dow Jones Industrial Average and this gap and this tweezer top over here and this secondary lower high, the potential breakdown taking place right now, please be open to the simple fact that there is a high possibility and potential that we are going to bounce very close to this 50 exponential moving average. But if we fail to overcome this resistance swing high over here, all bets are off on the intermediate trend. There is a very high probability that the intermediate trend itself is changing. Now, what does that mean for individual stocks? I posted a video also, I think 2 weeks ago, if not late last week, addressing the week just past. And I was saying you want to wait for confirmation with Dow theory. And really what I was suggesting is that you want to wait for this market to break above this significant swing high before you start positioning yourself into bullish trades. Because if you have done so over the past week, if not 2 weeks, you're obviously underwater on the market. The market itself has retraced, and a lot of individual companies have produced whipsaws to the upside. So it's a really good learning opportunity for people listening to me on YouTube to understand the significance of markets in agreement, which really leads me into some of these counterpart markets. I'll begin with the Dow Jones Transportational Average, because what we've seen, again, is an exceptionally powerful parabolic move to the upside. Really, since these lows over here at the beginning of 2016, we did get into a short-term sideways sort of channel consolidation, but really since President Trump elect in early November, the transportational average, much like the other equity markets, have only seen or known one particular direction, and that is up, 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 up. Since then, and this is where I want you to pay attention to, we've registered a high in December, a secondary high in January, and most recently a higher high in the month of March. Pay attention to the MACD. Again, some significant divergence between price and momentum. Very, very important that you understand that we are at the neckline once again, but we are into oversold territory. So expect that snap back to the upside. If we fail to register a higher high above the early March high, well, the writing's on the wall for weakness as we transition into April and May, even beyond into June 2017. I'm not calling some form of a terminal reversal. Obviously, we will have to move with the technical analysis, but I really want to show you just how important this is on the macro time frame. If you pay attention to the weekly signals as well on the MACD, the RSI, and the Stokes, pay attention. Sell, sell, sell. If you go back in history and if you go back and register, of course, when you see these in, of course, synchronicity with one another, you only have to go back to 2015 where we saw a pretty material pullback for an entire year, if not into 2016. We saw the stagnant type of range, and again, this is sort of like the channel consolidation which took place throughout the majority of 2016. But again, if you go back in time and you see some of these, or at least register some of these sell signals, you do get these material corrections, at least back into these very important long-term trend lines. So again, it is indicating a little bit of weakness on the intermediate time frame. However, be open to the bounce on the minor level, i.e. be open to the bounce which may take place over the next week, if not 2 weeks, until and if we set up some form of a lower high. It is very important for you to understand that and to register that and to understand how markets move. Now, I've brought up the incorrect chart. What I'm trying to do is bring up the Russell 2000 because, again, it's a really good indication of market breadth at this particular point. You can see, very much so like the transportational average, we have been rather stagnant. Now, we did produce another higher high in late February, early March, but pay attention to the divergence. It is the writing on the wall. It's across the board. On the weekly chart, look at this. You've got all of these markets registering, again, sell signals. Now, it doesn't suggest or it doesn't necessarily mean this is a top whatsoever. I don't want you to misconstrue what I'm saying. What this leads to is weakness, and weakness can really show up in two forms. It can really happen in this instance as a controlled pullback or a sideways market move. For us to get macro bearish and to suggest that the macro trend has changed, we need to see the continuation of bearish signals. We need to see a breakdown in market breadth, and we need to see some very important trend lines break. And that's not what I'm suggesting in this weekend market update. It's going to take quite some time for that to actually happen. It's very important, though, that you get a very good understanding of what's going on in the market, because right now it is very, very foolish to be jumping into bullish trades, to be buying the dip if the markets themselves are struggling to overcome most recent swing highs. And again, I spoke about this in great detail in the weekend's video just posted, which is up on the website at pivotpoint-trading.com. I would encourage you to have a look at that if you're interested in learning about technical trading and what it means for these companies such as Apple, Amazon, Boeing Airlines, Baidu. You can see the list on my left-hand side. 1 hour and 37 minutes of analysis. Again, we start with the markets, move into the dollar, gold and silver, and then move into individual trade analysis. Trades are brewing, which is somewhat exciting. And again, it all comes down to what happens with the markets. Do we just get a breakdown from this level? Do we break out above resistance? Or do we see, which is what I'm expecting, potentially something like this, a rejection at this pivot point and the confirmation of strong resistance mixed with those selling signals, which are very much so apparent across the board on all of these equity markets. So on that note, everybody, I'd like to wish you all a very nice weekend. I'll be back with you most likely during the week for some more weekday market updates and end of day market closure talks about the market if in fact we get some interesting candlesticks developing. But again, just think about what I have had to say in this week's video. Maybe rewatch it again if you want to refamiliarize yourself later on with what I'm expecting to happen in the equity markets. And on that note, everybody, have a great weekend. I'll be back with you in due course. All the best. It's James signing off on behalf of Pivot Point Trading. Goodbye.